Hey everyone, welcome in to another daily editorial here on the KE Report. Happy to introduce a new guest to all of you, our listeners, Ted Thatcher. He is the president of Bright Lake Wealth Management. Ted was introduced to me by a good friend who has provided me with a number of good generalist guests for the show. And talking to Ted and reading through at least some of his stuff that was sent to me, I think we have a good segment in front of us talking about his approach to the markets and a more balanced approach too. So Ted, when you and I were talking off mic, well, I was asking you, what do you see in this market? Where are the opportunities? And you outlined a three-pronged approach that deals a little bit with safety and also with having some of these winners, some of these outperformers in your portfolio. Can you take us through that three-pronged approach idea, please?
Yeah, absolutely. And Corey, it's wonderful to be with you. I do think a multifaceted approach is really important for at least many investors. And one thing that I think in years past we haven't had the luxury of is feeling that being patient is actually rewarded. And so I think a lot of us think, of course, we understand the principle of opportunity coming to those who wait and being patient and finding the right time. But I say all that in the context of I'm not at all upset about having some cash, some dry powder on the side right now because it's getting me over 5%. And again, I think that at some point, when you have some dry powder, you can find those good opportunities. And so I would pair that principle of patience with the other two prongs that you were just getting at. And so first, I would outline and highlight just what's happened this year in the markets. The truth is if you look at the S&P 500, almost all the return this year, which is I think over 14% as of today, is actually driven by big tech. And we can pick one name out of that big tech bunch, which we're all going to be familiar with. And that, of course, is NVIDIA because of the innovation they've had with their H100 hardware and obviously the effects that has had because of everything that's associated with artificial intelligence and the hardware necessary to run those models that we're seeing all over the place today. And so, first and foremost, because it has been so rewarding, not just even year to date, but in years past, to own big tech companies, and obviously, again, NVIDIA to be specific, I think that some would say, hey, tech's at a high, maybe lever out. And sure, maybe there's some reasonable investors that would say, let's take a little bit of risk off the table. But the truth is, historically, is even when big tech has had some volatility, if we are willing to let our winners ride, we are rewarded for it. So if I already have a position in NVIDIA, I'm not going to be scared just because it's had a really nice rise this year. Certainly, you could say the same about Apple or Microsoft as well. And so I think that there's still some reward to be left on the bone. Maybe not in the super short term. We'll see. I think that's a really hard prediction to make given how much rise they've had. But over the long term, there is what I would be thinking about. Now, in addition to that, I would zoom out even further and say, okay, well, since so much of the market has been driven by growth in big tech, what does that mean for small cap companies? What does it mean for mid-cap companies? And ultimately, I would point to the interest rate environment really being an informer here. We can talk about predictions with interest rates, but I think a lot of us would look at the futures market and say, okay, well, it seems like the market's starting to assume we'll get some interest rate decrease later this year. I think when I look at the political environment, there's a lot of political pressure for that. And so in a lowering interest rate environment, whether it did happen before the end of the year, which I think is reasonably likely, or in 2025, if we're trying to find some winners and not try to just pick the perfect horse out of the bunch, and we went sector specific, if we look at small cap, if we look even at mid cap, I think at a lowering interest rate environment is going to reward us on those as well.
So, Ted, when we get to this interest rate lowering environment, look, we've had the markets try to price in 7 rate cuts at one point last year. It's almost as though the markets have become numb to the Fed saying they're going to be cutting rates. Do these interest rate sensitive areas actually start to move when we finally get a rate cut? Is that the timing we're at now?
I think that's a really good question, Corey. And the way I would say that is I would go back to the comment you made, actually. So Jerome Powell at the end of 2023 in December came out and gave some really interesting expectations to the markets. And that was that 5, 6, 7 potential rate cuts. And the truth is, what has happened in the last 18 months is that the rate of inflation has been the informer on Fed policy and not the other way around, which is the way, of course, Jerome Powell would prefer it. Of course, meaning the rate environment being the dictator on inflation. Up until very recently, we've started to see that cool, right? Even in April, we saw that inflation hike, and I think everybody kind of got a little tight again. And the truth is, I would also just look at the general motivators. If we kind of rewind the clock back to post-COVID, when Jerome Powell was up for reappointment by President Biden, he kept rates really low, even though we had started to see, we started to see progress post-COVID. We were coming out of that. And I think he, if I'm just looking at the motivators, wanted to get reappointed, to be candid. Because I think if you show me your incentives, oftentimes I'll show you your results. And not that this is a political commentary, but I think it's noteworthy. And then we got this Build Back Better bill, which ended up being a lot of spending. There's just no other way of looking at it. There was a lot of spending in that bill. And it furthered a bit of the inflation problem. And so what I think I'm trying to get at is Jerome Powell had an incentive at that time. And I think his incentives have changed because, at least in my opinion, I don't think he'll try to search for reappointment. I think what he's worried about now is his legacy and being right. Because the markets realized he wasn't right in December, and he's really had this hawkish approach the last several Fed meetings. And so we've continued to see, even at the most recent Fed meeting, they say that they were going to keep rates at 5.25% to 5.5%. And so essentially, I think the markets have had to swallow that truth that we're not going to get all those rate decreases this year. And so it's a very long-winded way of saying, I do think once Jerome Powell is willing to say that he will lower again and really truly follow through on it, that is actually when you're going to see the small and mid cap reflect the consequence of those lowerings.
Do you think that also impacts commodities, energy, metals, those that can also be interest rate and dollar sensitive?
Sure, absolutely. I mean, the truth is, with the level of inflation that we've seen, gold and silver, gold is hitting all-time high, off that a little bit. Silver was coming back to life there. At the end of the day, I think every American is looking at their pocketbook and saying, how can I preserve my buying power? The other way I would even put that in a macro commentary standpoint would be, there does seem, at least to me, to be a big difference between what's happening on Wall Street, the market being near an all-time high, and what's happening on Main Street in the United States, with inflation really affecting buying power. And so I do think that there is absolutely a commodities effect here, just in general, with the consumer being so concerned about how far the dollars are going.
Yeah, boy, we've seen that. Hey, the disconnect between Main Street and Wall Street, even when it comes to economic data. Sometimes bad data, good news for the markets, again, because everyone's pricing in or trying to get ahead of a Fed rate cut. When you talk about big tech and letting the winners ride, big tech, we've also heard the narrative that it's being looked at as a defensive play because of their high cash levels and how they don't need lower interest rates to grow. Do you look at big tech also as a safety play then?
I think at the end of the day, any company that you're going to see a lot of volatility from, I wouldn't go straight to safety. But I do think that when we think about big tech, a lot of us think blue chip. And sure, there's an association of safety there, or reliability, staying power, and all those things. When I think about safety, though, truth be told, I really would go more towards a precious metal that's tried and true, like a gold, even like a silver. Or again, the truth is, Warren Buffett would say gold doesn't have utility, and therefore I'm not going to invest in it. And so I would kind of come back to the cash on that point and say, hey, if I'm still getting 5% and I really want to be safe, I'm not going to turn my, nose up at that.
So if you're trying to get ahead of the Fed rate cut, whenever that is, because that could be such a market driver, Are you simply looking at inflation, the jobs data? Or are you looking at other things, either globally or domestically?
So obviously, I definitely will. I would kind of come back to what you mentioned there, which is this dichotomy between bad economic data actually being a justification for the Fed to be able to lower rates. And so, what I'm looking at primarily is the PPI data, the CPI data, and the jobs data. And ultimately, those data points speaking to what the Fed's dual edict, their mantra really is to maintain a moderate rate of inflation at 2% and to keep a low unemployment rate below 4%. And so that's what I've had my eye on. If we kind of go back, actually, perhaps it's interesting to listeners here. When we did have that spike in the CPI in April, I think everybody was quite concerned about it because of, practically speaking, what so many people were feeling. And it's also why I mentioned before too, just the fact that the rate of inflation I really felt has informed Fed policy, despite the, contrary being the desire from Jerome Powell. And so when we think about that inflation rate and the numbers that were coming out, Larry Summers, the previous Secretary of the Treasury, came out with a pretty, I think, viral thread on X, actually. I thought it was quite interesting. He keeps a tracker, actually, of what the CPI used to be calculated as. And so, as you may know, of course, but for the sake of the listeners, the CPI has changed how it's been calculated. The rate of inflation, the way that we see it printed today, has changed drastically over time and no longer includes the cost of borrowing. And obviously, for many Americans, most Americans, the cost of borrowing is a huge effect on their daily life because of how much debt load we carry as Americans in general. And secondly, they allow for proxies now, which basically allows them to say, okay, if the price of meat went up 10% this year, well, what was the price of chicken? What was the price of tofu or something like that? And just swap it out, basically do these changes. And so by Larry's measure, inflation went up more like 20% instead of peaking at 9%. And so again, it just comes back to that point of, I do believe the average American is looking at buying power as a big informer on what they need to do with their financial assets because of how it's been eroded.
Yeah, what a world we're living in right now. How different it truly is, especially with this higher for longer type narrative. Ted, just a quick question. When you're looking at building a portfolio for your clients, what's the time frame and just how active do you get in adjusting that portfolio, whether it's individual positions or overall strategy?
I think that, of course, it comes down to the investor. But when we think about it, typically we say, okay, well, what's the need? Is this a long-term growth desire? And what do we need in the short term? So the way I like to think about that is when we come up with an investment plan, what it really boils down to, there's a lot of technicalities that can go into it, but what do we need to have set aside for income? And what do we need to have set aside for growth? And so once you have that framework, I think you can really start to build something that is, well, going to last and serve the need, if that makes sense. And so basically, when it comes to the income side, obviously, a lot of people are thinking about dividend stocks, more moderately allocated portfolios. And what I think, though, maybe some of us have gotten wrong is too often in the marketplace, we've seen these almost set it and forget it type of investment strategies for income. And what we've watched happen over the last 3 years almost now, two years for sure, with the interest rate hiking cycle, is when I've looked at portfolios, so many people will just throw bonds into a conservative portfolio because it's a best practice. And what I saw so many times, Corey, was that these set it and forget it strategies were levered into really long-term, medium and long-term bonds, getting a 1.5% yield and getting absolutely taken to the cleaners because nobody went in and changed the maturity on the bonds which were losing value hand over fist as Jerome Powell raised interest rates. And it ultimately ended up putting a tremendous amount of pressure, of course, on Americans who are seeing losses in their portfolios. But it was emphasized with an exclamation point in the Silicon Valley Bank collapse, and the Signature Bank collapse, and the stress that was put on the banking system, which the Fed had to relieve with that BTFP, the Bank Term Funding Program that they released.
Yeah, what a time that was. Hey, that sure scared some people out of the market. Still, a number of people saying the regional banks are still an issue, but even those charts have moved broadly sideways in kind of a boring nature over the last 4 weeks. Ted, thank you very much for taking time to share your thoughts on the markets. I will post a link to the Bright Lake Wealth Management website in the show notes. Please, everybody, let me know what you thought of Ted, when I should bring him back on, and any other topics you want to hear his thoughts on. Ted, thanks for your time. Have a great rest of your week.
Corey, thank you.